Hi guys, this is CA Balakrishna from Lecturepedia.in. How are you? Hope you people are doing well. Even I am fantastic. In the today's video, we will be revising audit of consolidated financial statements. And if you want to download this revision charts, you can download it from our Telegram channel, and the link for Telegram channel you can find it in the description. And if you want to purchase classes, you can visit our website Lecturepedia.in and you can place your order. Okay, now without any waste of time, let us start the revision. Audit of consolidated financial statements. What are these consolidated financial statements? Let's say there is a company A Limited. Now this A Limited is having some subsidiaries, some associates and some joint ventures. Now A Limited will prepare standalone financial statement. In the same way, subsidiaries will prepare their standalone, joint ventures will prepare their standalone financials, and associates will prepare their standalone financial statements. Now on A Limited, on the holding company, apart from preparing standalone financial statement, it should also prepare consolidated financial statements, consolidating the financials of all these subsidiaries, associates, joint ventures and also A Limited. So this is the obligation on A Limited. Now which section mandates preparation of consolidated financial statements? Section number 129 subsection 3 of Companies Act 2013 mandates a holding company to prepare consolidated financial statements. See section number 129 subsection 3. If a company has one or more subsidiaries, associates or joint ventures, we will be calling them as components. For the purpose of consolidated financial statements, we will be calling subsidiaries, joint ventures, associates as components. If a company is having components, then it must, along with preparation of standalone financial statements, it should also prepare consolidated financial statements. Now for the preparation of consolidated financial statements, all the provisions that are applicable to standalone financial statements will be mutatis mutandis applicable even for the preparation of consolidated financial statements. It is said by section number 129 subsection 4. Now coming to the non-applicability of preparation of consolidated financial statements. As per Companies Act 2013, if a company satisfies three conditions, then it need not prepare consolidated financial statements. What are these three conditions? Let me explain you. Let's say there is A Limited. A Limited is holding company of B Limited, and B Limited is holding company of C Limited. Now in this case, let's say B Limited wanted to take exemption from preparation of consolidated financial statements. In this case, what are the conditions that has to be satisfied by B Limited? First of all, what the B Limited has to do is, B Limited has to intimate to its members stating that, see members, we don't want to prepare consolidated financial statements, whether you are having any objection for this. If no member objects for preparation of for non-preparation of consolidated financial statements by B Limited, then B Limited can take exemption from preparation of consolidated financial statements. So what is the first condition? A partly owned or a wholly owned subsidiary, if after taking no objection from shareholders, then it can avoid or take exemption from preparation of consolidated financial statement. This is the first condition. Along with first condition, the second condition is the shares of these B Limited should not be listed on the stock exchange or not in the process of listing. This is the second condition. And the third condition is its ultimate or any intermediate holding company should prepare a consolidated financial statements. In our example, A Limited must prepare consolidated financial statements. If A Limited prepares consolidated financial statements, then B Limited can take the exemption. These are the three conditions. If satisfied, B Limited can take exemption from preparation of consolidated financial statements as per Companies Act. These are the three conditions you can go through. Now there are also exemptions available as per Ind AS and also as per accounting standards. What are those exemptions? Let us see. Here we have discussed exemption as per Companies Act. Now we are discussing exemption as per standards, accounting standards and Ind AS. Now coming to the accounting standards. Accounting standard number 21 deals with the consolidation of financial statements. Here there are two exemptions available. Firstly, if the holding company purchases the subsidiary with an intention of temporary control, That means the holding company doesn't want to hold subsidiary for a longer time. The intention of holding company is just to make profit, some short-term profit by trading in the shares of that subsidiary. If that is the intention, then such holding company need not prepare consolidated financial statement of including such subsidiary. Hope this is clear. This is the first condition. Next, another condition. If there are severe long-term fund transfer restrictions on the subsidiary, even then the holding company need not prepare consolidated financial statement. Hope this is clear. This is as per accounting standard 21. Coming to the Ind AS. Now as per Ind AS, if the holding company is a investment company, then it need not prepare consolidated financial statements. What is meant by an investment company? See, in our same example, let's say this B Limited is there now. B Limited is a investment company. Let's say investment company means there are three conditions that has to be satisfied in order to call a particular company as an investment company. First of all, let us see which companies can be called as an investment company. See, now the main objective of the investment company is it will collect amount from the investors and it will provide investment management services to the investors. What it will do is it will take this amount and it will invest in various investments in various companies. This is the service that is provided by the investment company, and the major idea or the major income that the investment company generates is either capital appreciation or income from investments in the form of dividend interest. This is the second condition in order to call a particular company as an investment company. And the third condition is it measures its investments on fair value basis. These are the three characteristics of a investment company. Now let's say this B Limited is there now. This B Limited is a investment company. That means it will collect amount from the investors and it will invest in various companies. Now in this case, since B Limited is an investment company, it need not prepare consolidated financial statements as per Ind AS 110. Okay. Now A Limited is holding B Limited and B Limited is an investment company. Now tell me whether A Limited has to prepare a consolidated financial statements. The answer is yes. A Limited has to prepare a consolidated financial statement of including the financials of B Limited and all the investments made by the B Limited. The exemption is only for B Limited because B Limited is an investment company. But if that particular investment company is being held by another company which is not an investment company, then such holding company must prepare consolidated financial statements. Here, if A Limited is also an investment company, then A Limited need not prepare consolidated financial statements. Hope this is clear. Now, those are the exemptions and definition of investment company. Okay. Now, for preparation of consolidated financial statements, there are certain responsibilities on the parent entity. Parent entity means holding company will be known as a parent entity. What are the responsibilities on the parent entity regarding preparation of consolidated financial statements? The first responsibility is it has to identify all the components. How many subsidiaries we are having, how many joint ventures we are having, how many associates we are having. All this data has to be collected and included in the consolidated financial statement by parent company. Okay. Next, it has to identify reportable segments for the purpose of segment reporting. Okay. Next, it has to identify related parties and related party transactions for the purpose of disclosure and reporting in consolidated financial statements. And it has to obtain accurate and complete financial information from all the components. In the first step, it identifies all the list of components. Now, from it has to make sure that it will obtain all the complete and accurate financial information from all these components. Okay. Next, it has to make appropriate consolidation adjustments. What are these consolidation adjustments? We are having two types of consolidation adjustments. One is permanent consolidation adjustments and another one is current period consolidation adjustments. We will be discussing about them. Next, it should harmonize accounting policies and accounting framework. Generally, in foreign subsidiaries, what happens is the accounting policies and accounting framework that will be followed by a foreign subsidiary will be different from the accounting framework that is being followed by Indian parent entity. In those cases, Indian parent entity has to harmonize the accounting framework that is being followed by the foreign subsidiary as per the Indian framework. It has to bring its financial statements to the Indian framework. Okay, that is the another responsibility on the parent entity. Next, gap conversion. generally accepted accounting principles. Same, this example only you can take here also. Those are the responsibilities of parent entity. Now coming to the responsibilities of auditor. What are the responsibilities of the auditor with regard to audit of consolidated financial statements? The first responsibility is CFS have been prepared as per applicable financial reporting framework or not. Auditor has to check whether the consolidated financial statements of the company have been prepared as per the applicable financial reporting framework or not. Next, auditor has to express opinion on the true and fair view of consolidated financial statements. Okay, whether the balance sheet is showing true and fair view, whether the P&L is showing true and fair view. Like this, he has to express an opinion on the consolidated financial statements in his audit report. He has to issue an audit report. Okay, next, he has to inquire on matters specified under section number 143 subsection 1 of Companies Act. Here, if you remember, in the Companies Act we have discussed some 6 points on which the auditor has to make an inquiry. Okay, that section number 143 subsection 1 is applicable even for audit of consolidated financial statements. In the same way, if you remember, we have section number 143 subsection 3 where we are having around 11 points on which auditor has to report. That is, report matters specified under section number 143 subsection 3. Even that reporting requirement is applicable for audit of consolidated financial statements. And lastly, auditor has to check whether preparation of consolidated financial statements is actually applicable to the entity or not. See, validate the requirement of preparation of consolidated financial statements. These are the responsibilities of the auditor with respect to preparation of consolidated audit of consolidated financial statements. Next, consideration regarding materiality. Generally, while conducting audit of standalone financial statements, auditor will determine the materiality for the parent entity only. But here, auditor is conducting audit of consolidated financial statements. So, auditor has to determine materiality at the group level. So, compute materiality for the group as a whole. Let me use another pen. Yeah, compute materiality for the group as a whole. After that, auditor has to assess whether the consolidation adjustments that have been made by the entity are appropriate or not. Next, auditor has to use this materiality to determine whether the component that has been included in the consolidated financial statement is material for the entity or not. For entire group, whether that component is material or not based on the materiality that has been decided by the auditor. Next, compute the materiality for each component and communicate this materiality to the auditor of the component. See, sometimes what the auditor can do is, if auditor feels that the component is very important for entire group, then auditor can individually calculate the materiality level for that component and he can communicate that materiality level to the auditor of that component. Hope this is clear. Next, obtain confirmation from the component auditor regarding independence and code of ethics, whether the component auditor is acting independently or not, whether he is following all the ethical requirements or not. Like this, these confirmations can be obtained by the parent auditor, by the auditor of consolidated financial statements from the auditor of the component. Hope this is clear. Next, coming to the planning of audit of consolidated financial statements. How the auditor will plan the audit of consolidated financial statements? First of all, what the auditor will do is, auditor will obtain understanding of the group structure. How many subsidiaries there are, how the subsidiaries are structured, okay, how many associates are there, how they are structured. Like this, he will first of all obtain understanding of the group structure. Okay, understood, group structure. Next, what he will do is, he will understand the accounting policies that are being followed for the preparation of consolidated financial statements and for the preparation of standalone financial statements. So he will obtain understanding of the accounting policies. Next, he will determine the nature, timing, extent of audit procedures that has to be performed by the auditor. See, determine nature, timing, extent of audit procedures that has to be performed by the auditor. Next, here in case of consolidated financial statements, if the financial statements of group subsidiaries, associates or components are audited by some other auditor, then the auditor of consolidated financial statements will have to rely or will take the help of that other auditor. Okay, he will rely on the audit report that has been issued by the component auditor. Here he will use the work of other auditor, that means SA 600. He should also consider the implications of SA 600 if he is using the work of other auditor. See, determine the extent of use of other auditors work, SA 600. Next, coordinate the work to be performed. This is how auditor will plan the audit of consolidated financial statements. Now, okay, Auditor is conducting the audit of financial statements, consolidated financial statements. He has asked the management to give the list of components. Now management has given the list of components. Now how the auditor will verify whether the list of components that is given by the management is complete or not, whether management is missing inclusion of any component in the consolidated financial statements. How the auditor will verify this? See, procedure to assess completeness of components to be consolidated, whether all the components have been consolidated or any component is missing. How the auditor will identify this? First of all, what the auditor will do is, auditor will review the prior periods, prior years audit working papers, because by seeing audit working papers of prior year, let's say in the previous year, subsidiary A, subsidiary B, subsidiary C, subsidiary D, these 4 subsidiaries have been consolidated, but in the current year only these 3 subsidiaries have been consolidated. Now by seeing the previous year working paper, auditor will come to know that in the previous year 4 subsidiaries were consolidated, but now there are only 3. Why? So he can inquire with the management. Management might say that during the current year we have sold the subsidiary or we have lost control, like this. The reasons will be given by the management. This is one of the procedure that the auditor can perform. Next, review parent's procedures for identifying of components. How the parent entity is identifying the components, that procedure has to be understood and reviewed by the auditor. Next, inquiries of management to identify new components. Okay, he has to inquire with the management whether during the year you have identified any new components, whether you have made investments in any new subsidiaries. Like this, auditor will have to make inquiries with the management. Next, review of investment of parent and component to find shareholding in the other entities. What the auditor can do is, auditor can take the investment account or list of investments made by the parent entity during the year. Okay, by reviewing that, auditor can come to know whether any new components, whether entity has invested in any new components. This is another audit procedure that the auditor can perform. Next, auditor can review joint ventures, joint arrangements and other arrangements entered into by the group. Generally what happens is, he can see whether during the year any associate has been converted to subsidiary, or any subsidiary has been converted to associate, or any joint venture has been converted to subsidiary. Like this, whether any such type of conversion has taken place during the year, this has to be verified. Next, review the statutory records of the entity. Example, minutes of board meeting. In the board meeting, entity might have discussed about a particular component, and if that component is not included in the consolidated financial statements, auditor can inquire with the management. Okay, in this board meeting you have made discussion regarding this component. There you have mentioned that this component is a subsidiary, but you have not included in the consolidated financial statements. Why? Like this, auditor can question by reviewing the statutory records. Next, identify changes in the shareholding that has taken place during the year. All these audit procedures auditor can perform in order to determine the completeness of the components that have been included in the consolidated financial statements. Next, coming to the consolidation adjustments. See, there are 2 types of consolidation adjustments. One is permanent consolidation adjustment and another one is current period consolidation adjustments. What is the difference? These permanent consolidation adjustments, they are made only on the first occasion or on the subsequent occasion when there is a change, but whereas current period consolidation adjustments, they are made every year. That is a major difference. So permanent consolidation adjustments made only on the first occasion or subsequent occasion when there is a change in the shareholding, whereas current period consolidation adjustments, they are made in the accounting period for which the consolidated financial statements are being prepared. Now what are examples of current period consolidation adjustments and what are examples of permanent consolidation adjustments? We will be seeing that. In the permanent consolidation adjustments, we are having only 2 adjustments. First one is determination of goodwill or capital reserve. Whenever you purchase any subsidiary, then while consolidating, a goodwill or capital reserve will arise. You have to calculate this goodwill or capital reserve. If you studied FR, financial reporting Ind AS 110, there you will be calculating making sums on this. issue. So this is the permanent consolidation adjustments, and another one is determination of equity attributable to minority or non-controlling interest. Minority you will be calling as per AS 21, and non-controlling interest you will be calling as per Ind AS 110. What is the equity attributable to these people? Even this is a permanent consolidation adjustment. Now in regard to this permanent consolidation adjustment, what has to be verified by the auditor? Basically auditor has to verify the calculation of pre-acquisition reserves, how the pre-acquisition reserves has been determined. This pre-acquisition reserves plays a very important role in calculating these capital reserve and goodwill. Thereby auditor has to verify the pre-acquisition reserves. For this pre-acquisition reserves, the important aspect that has to be taken into consideration is what is the date of investment, because all the reserves before date of investment they will be pre, and after investment they will be post. So you have to determine examine this date of investment. Next, whether these pre-acquisition reserves have been properly allocated between the parent entity and the minority, even this has to be verified by the auditor. And finally, verify changes in these shareholding that takes place in the current year. Okay, these three has to be verified by the auditor regarding permanent consolidation adjustment. Coming to the current period consolidation adjustment. These current period consolidation adjustments or adjustments that are done during the current accounting period. Now what are the example? First one, intergroup interest or management fee received. Let's say holding company paid interest to the subsidiary. Now for holding company it is expense, for subsidiary it is income. Now when you club these two, there is no need to show this income and expenditure separately, so you will adjust that, you will set off that. So this is one of the example of current period consolidation adjustment. In the same way, unrealized intra-group profits on disposal of fixed assets between the components or between the parent entity and the components. Okay, the profit that has been arised on disposal or transfer of assets in between the components or between the parent and the component, even those unrealized profits will be adjusted. Now while you adjust these profits, some deferred taxes will arise, so you should also record these deferred taxes. And intra-group indebtedness will also offset this intra-group indebtedness. Next, adjustment related to harmonizing different accounting policies. If the components are following different accounting policies, then you have to harmonize the accounting policies of all the components to the accounting policy that is being followed by the parent entity. In the same way, gap conversions. This gap conversion, it will be relevant to the foreign subsidiary. Okay, next, coming to adjustment for subsequent periods. Now let's say the consolidated financial statements are prepared as on 31st March 2000, let's say some. Okay, as on 31st March, consolidated financial statements are prepared. Now auditor gives his audit report on consolidated financial statements on, let's say, 7th of May. Okay, now the transactions that occur between this period, okay, here these will be known as subsequent events. These can be of two types: adjusting events, non-adjusting events. Now auditor has to consider whether all the adjusting events have been properly adjusted in the consolidated financial statements or not. This is the adjustments related to subsequent events. Next, there is also another concept. Now let's say, you please listen this carefully, otherwise you will not understand this. Now subsidiary has prepared its financial statements as on 31st December. Subsidiary is following this calendar year as financial year, but parent has prepared, or the CFS, generally consolidated financial statements. Consolidated financial statements will be prepared as on 31st March, and the audit report will also be given as on 31st March. Okay, based on the financial statements prepared as on 31st March, based on these financial statements, audit report will be given. Now there would be some transactions that has taken place in this subsidiary during this period. Okay, from 31st December till 31st March, some transactions would have been taken place. Even these transactions should be adjusted in the consolidated financial statements. Okay, even this comes under current period consolidation adjustments. When this situation arises, when the balance sheet date of subsidiary is different from the balance sheet date of consolidated financial statements. Hope this is clear. So these are the current period consolidation adjustments. Here you can see you should also determine movement in the equity attributable to minority interest or non-controlling interest. When it arises, generally if during the year if you sell the control or sell the shares of the subsidiary of you, or you purchase additional shares of the subsidiary, then this change will occur. Okay, in that situation this point will be relevant. And next is adjustment related to deferred taxes. All these will be coming under current period consolidation adjustments. Next, now in the consolidated financial statements you have to make certain disclosures. There are certain 3 types of disclosures which has to be mandatorily given. What are they? First one, see, information to be disclosed in the consolidated financial statements. This information you have to give separately for parent and component. What is this? First of all, amount of net assets and percentage of consolidated net assets. What is the amount of net assets of parent, and what is the amount of net assets of subsidiary, and what is the percentage of net assets of parent to the total assets, and what is the percentage of net assets of the component to the total assets. Okay, this disclosure has to be made in the consolidated financial statements related to the assets. In the same way, related to profit and loss, okay, share in the profit and loss, same type of disclosure, but here related to profit and loss. Next, amount of OCI and percentage of consolidated OCI, same disclosure related to OCI. Hope this is clear. These 3 disclosures has to be made mandatorily, and there are certain disclosures which need not be made in the consolidated financial statements. What are those disclosures? First one, source of bonus shares issued. Now during the year, if the bonus shares are issued, then what is the source for issuing that bonus shares? Whether you have utilized reserves or you have utilized securities premium, that need not be disclosed in the consolidated financial statement. In the standalone financial statement you will disclose, but that disclosure not required in the consolidated financial statements. In the same way, disclosure of unutilized money. If you have raised money from IPO, FPO, and you have not utilized them and you have placed them in certain investment, then that disclosure need not be given in consolidated. You will be giving the disclosure in the standalone. Next, disclosure related to micro small MSME Act. Even those disclosure need not be given in the consolidated financial statements. Next, disclosure of investment. Generally in case of standalone financial statements, you will be giving a statement. Okay, what is the name of the company in which you have invested, how many shares you have invested, what is the amount of investment, what is the percentage of investment. All these details you will be giving in standalone financial statement, but the disclosure not required in consolidated financial statements. Next, value of imported versus indigenous raw materials utilized during the year. Okay, how much amount of imported raw materials you have used, how much amount of indigenous, that means purchased locally within India. Okay, that bifurcation has to be given. Next, expenditure in foreign currency on account of royalty know-how. Okay, what is the amount of expenditure that you have incurred in foreign currency for the purpose of royalty and know-how and other management fees, professional management fees. And earnings in foreign currency. What is the amount of earning that you have made during the year in the foreign currency, in the form of following bifurcation. Okay, this bifurcation you will be giving in standalone financial statement, but it is not required in case of consolidated financial statement. Hope this is clear. See, all these disclosures need not be made. Okay, these disclosures, 3 disclosures need to be made. Okay, to be disclosed. Hope this is clear. Next, you should obtain certain management representation letters. Okay, related to what? Related to completeness of components. You have to take a written representation from the management stating that management you have given us the list of components, na? Whether all the list of components is accurate and complete. You have not missed any component. Like this, give a written representation to us. Okay, this is the first written representation. Next, identification of reportable segments. Whether the management has identified all the reportable segments or you have missed any reportable segment. You give a written representation regarding this. In the same way, related party transactions. Next, appropriateness and completeness of permanent and current period consolidation adjustments. Okay, these written representations has to be taken from the management. By this, almost consolidated financial statement is completed. We are having just one topic. This is very important, which is reporting aspect. Reporting by whom? Reporting by auditor of consolidated financial statements. Here we will be having 5 situations. Okay, in these 5 situations, how the auditor will have to report. First situation is parent's auditor is also auditor of components auditor. Okay, the auditor of A Limited holding company is also auditing the components financial statements. In that case, what has to be checked by the auditor? Okay, how the auditor has to report. That is the first situation. Second situation, parent auditor is different from component auditor. Okay, these are the first 2 situations. First of all, we will see the reporting in case of these 2 situations. Now, parent auditor is also the auditor of component auditor. In that case, what the parent auditor has to do is he has to check whether the consolidated financial statements have been prepared as per applicable financial reporting framework or not, whether consolidated financial statements have been prepared as per the applicable financial reporting framework, that is accounting standards Ind AS. Next, in case there is any deviation, he has to consider the implication of SA 705 modification to the opinion. Next, he has to issue audit report on the consolidated financial statements, whether in the balance sheet, the consolidated balance sheet is showing true and fair view, consolidated P&L showing true and fair view, consolidated cash flow showing true and fair view. Okay, this audit report to be issued by the auditor. This is the reporting requirement in case parent auditor is same as parent auditor and the component auditor is same. Okay, next, reporting auditor, if parent auditor is not same as the component auditor, okay, parent auditor and component auditor are different. In that case, consider SA 600. The auditor of consolidated financial statements, what he has to do is he has to consider the requirements of SA 600, because here he is using the work of other auditor. Okay, he will consider the requirements of SA 600. Next, indicate the portion of financial statements audited by other auditor. Okay, in the consolidated financial statements, how much portion of these consolidated financial statements are audited by other auditor? Okay, that disclosure can be given by the parent auditor, the auditor of consolidated financial statements. How he can give? He can give asset wise. Okay, in this total assets, this much of assets are audited by component auditor, or in the total revenue, this much of revenue audited by that particular auditor, or this much of cash flows are audited by that particular component auditor. Like this, he can give disclosure. And you should remember that such a disclosure made by the parent auditor in his consolidated financial statement audit report should not be considered as qualification. Okay, it is not a qualification. He is just giving a disclosure that this much amount of assets or revenue is audited by some other auditor. You should not consider this as a qualification. Hope this is clear. See, such reference by parent auditor should not be considered as a qualified opinion. You should not consider this as a qualified opinion. These are the first 2 scenarios. Okay, coming to the next scenario. Accounting framework. The accounting framework that is being followed by the parent entity is different from the accounting framework that is being followed by the component. In this situation, what has to be done? First of all, parent's management shall convert components financial statement to framework followed by the parent. Okay, the subsidiary is following different accounting framework. Now, what the management has to do is management has to convert the financial statements of that particular subsidiary into the accounting framework that is being followed by the parent entity. Such a conversion has to be made by management. Once such a conversion is made, what the auditor will do? Auditor will audit that conversion adjustments made by the management. Hope this is clear. This is the first thing that can be done if the accounting framework is different. And the second thing that can be done is what the component can do is component has prepared its financial statements as per other framework. Now, what the component can do is component itself can again prepare the financial statements as per the framework being followed by the parent entity and get its financial statements audited by the auditor, and that audit report can be given to the auditor of the consolidated financial statements and he will use that audit report. Hope this is clear. Alternatively, component itself can prepare financial statements on basis of parent's accounting framework and local component auditor issue audit report on above financial statements which will be used by the parent auditor. Hope this is clear. This is the reporting requirement when accounting framework of parent is different from accounting framework of component. Coming to the next situation, auditing framework. Earlier it was accounting framework, now auditing framework. Okay, auditing framework that is being followed by the parent auditor is different from the auditing framework that is being followed by the component auditor, because parent auditor has to rely on the audit report that will be given by the component auditor. If he has to rely, means component auditor has to audit that particular component based on Indian gas, that means generally accepted auditing standards, that has to be used by the component auditor, but he is using some other auditing framework that is not acceptable. Okay, components financial statements shall be audited under Indian gas only. Okay, gas means generally accepted auditing standards. Next, components are not audited at all. Okay, if the components financial statements are not audited, then the auditor of parent entity, the auditor of consolidated financial statements, what he has to do is he has to consider what could be the impact on his opinion. Okay, because if the components financial statements are not audited, means the auditor of the consolidated financial statements is not able to obtain sufficient appropriate audit evidence regarding that particular component. In this case, he might have to modify the opinion, so he has to consider SA 705 in this situation. Okay, auditor of consolidated financial statements shall consider impact on the opinion. Hope this is clear. This is the reporting requirement as per consolidated financial statements. You can consider this as very important. Okay, by this, revision of consolidated financial statements is completed, and I will be meeting you in the next class with a new chapter. And if you want to purchase classes, you can visit our website lecturepedia.in and you can place your order. Take care. Bye bye.